This is a breaking financial update with major implications for currency markets and regional economies alike. The Vietnamese Dong, or VND, has just shattered a crucial psychological and technical barrier, surging past the $5.10 mark for the first time in recent history. Traders across Southeast Asia and beyond are watching closely as the currency demonstrates an unusual strength in what many are calling a surprising upward momentum. While local and international investors have anticipated some appreciation amid Vietnam's economic rebound, this sudden movement has caught even seasoned analysts off guard. The key question now is, will rates climb even higher? This latest jump comes on the back of a combination of macroeconomic indicators and sharp changes in monetary behavior. Recent trade surplus figures released by the Vietnamese government reveal stronger than expected export performance, particularly in electronics, textiles, and agricultural products. At the same time, foreign direct investment continues to accelerate, with significant commitments pouring in from Japan, South Korea, and the European Union. These capital inflows, fueled by stable governance and an increasingly investor-friendly regulatory landscape, have supported demand for the Vietnamese Dong in both onshore and offshore markets. Meanwhile, the US dollar has been showing signs of weakness over the past several weeks, following dovish language from the Federal Reserve and disappointing job creation data stateside. This softening in the greenback has added fuel to the Dong's rise, further exacerbated by regional currency shifts and a rotation of capital away from traditionally dominant currencies. Speculation about future rate cuts in the United States has put additional pressure on dollar-denominated assets, prompting investors to reassess emerging market currencies with stronger growth trajectories. The VND's surge is also being linked to a subtle but strategic shift in monetary policy by the State Bank of Vietnam. Without making any dramatic announcements, the central bank has quietly adjusted key levers, lowering reserve requirements for select sectors, improving liquidity in domestic credit markets, and gradually relaxing capital account restrictions. These moves have made the Dong more attractive, particularly for institutional investors seeking stability with upside potential. This comes at a time when Vietnam's inflation has remained remarkably contained despite global food and energy shocks, giving policymakers more flexibility than their regional counterparts. Currency desks in Singapore, Hong Kong, and even London are now closely watching the Vietnamese Dong as volumes spike and volatility ticks upward. While the $5.10 level has served as a historical resistance point in previous cycles, the clean break seen in today's trading indicates strong conviction behind the move. Technical analysts are now pointing to $5.25 and even $5.30 as the next possible targets, depending on how global conditions evolve over the coming weeks. However, not everyone is celebrating. Some economists are warning that a rapidly appreciating Dong could create pressure for Vietnam's exporters, who have long benefited from a relatively undervalued currency. There are concerns that if the currency strengthens too quickly, it could erode the competitive pricing advantage that has made Vietnam such a magnet for global supply chains. In turn, this could impact employment and profit margins in export-heavy sectors. Vietnamese officials have so far declined to comment on whether they plan any direct intervention, though recent history suggests they are unlikely to tolerate excessive volatility. Adding to the complexity is the current geopolitical backdrop, where tensions in the South China Sea and uncertainties around global trade policy are injecting additional risk into an already jittery market. With the upcoming ASEAN Economic Summit just weeks away, regional leaders are expected to discuss mechanisms to ensure greater currency coordination and financial resilience. There's growing sentiment that the Vietnamese Dong may no longer be seen as a passive regional player, but rather as a currency on the rise, deserving of greater attention from both portfolio managers and policymakers alike. In local markets, sentiment is electric. Banks and brokers are reporting unusually high interest from retail investors, many of whom are rushing to buy into the Dong in hopes of further gains. At the same time, Vietnamese businesses that rely on imported goods are already calculating the impact of a stronger currency on their bottom line. Some are welcoming the relief it brings on the cost of imported raw materials, while others are rethinking their pricing strategies for the months ahead. Consumer confidence appears to be climbing, but analysts caution that the real test will come if and when capital flows begin to slow or reverse. International hedge funds and proprietary trading firms have also entered the fray, capitalizing on arbitrage opportunities and forward contracts. There's talk in the financial community that several large players have built up long positions in the Dong over the past 3 quarters, which could explain the velocity of the recent breakout. These bets now appear vindicated, but the speed of the move has raised questions about sustainability. Will the fundamentals continue to support this level, or are we witnessing a speculative bubble that could unwind just as fast? The outlook remains fluid. Market participants will be watching closely for any new policy signals from the State Bank of Vietnam, particularly regarding interest rate guidance or currency stabilization measures. Meanwhile, attention will also turn to the next round of trade and GDP data, both of which will play a critical role in shaping expectations. If growth continues to accelerate and external demand remains resilient, the Dong may very well have room to run. But if headwinds emerge, whether from geopolitical tensions, commodity price spikes, or shifts in investor sentiment, the rally could face stiff resistance. Adding another layer to this complex picture is the recent shift in regional manufacturing dynamics. As global companies continue to diversify supply chains away from China, Vietnam has emerged as a clear beneficiary. Major tech and apparel brands are expanding their operations in the country, bringing with them not only investment capital but also sustained demand for the local currency. This structural tailwind is likely to lend longer-term support to the Dong, though the timing and scale of its impact will depend on broader global conditions. At the same time, risks remain. Any signs of overheating in the real estate market or a credit bubble in consumer lending could force regulators to step in more aggressively, potentially curbing currency momentum. Similarly, should inflation begin to creep upward, the central bank may have little choice but to tighten, which could dampen economic activity. These are the balancing acts that Vietnamese authorities will have to manage carefully in the weeks and months ahead. The outlook remains fluid. Market participants will be watching closely for any new policy signals from the State Bank of Vietnam, particularly regarding interest rate guidance or currency stabilization measures. Meanwhile, attention will also turn to the next round of trade and GDP data, both of which will play a critical role in shaping expectations. If growth continues to accelerate and external demand remains resilient, the Dong may very well have room to run. But if headwinds emerge, whether from geopolitical tensions, commodity price spikes, or shifts in investor sentiment, the rally could face stiff resistance. Adding another layer to this complex picture is the recent shift in regional manufacturing dynamics. As global companies continue to diversify supply chains away from China, Vietnam has emerged as a clear beneficiary. Major tech and apparel brands are expanding their operations in the country, bringing with them not only investment capital but also sustained demand